Welcome to the Dividend Talk podcast, episode 137. Intel has cut its dividend. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. You're back from your vacation. How are you, buddy?
I have felt better before, as you can see and observe. I'm just recovering from a flu. I'm not 100% yet, but let's see how today goes on an 80% brain capacity and my head full of, flu kind of symptoms. How are you doing?
I'm good. I'm good. I'm starting to feel it a little bit as well today, I have to say. Not quite as bad as you, but hey, this is passion, isn't it? We still show up even if we're not feeling well. We have to do this every single week. So let's play on and see how we get on. And Intel cut its dividend. I assume people expect us to speak about that. We talk about Intel quite a bit on the show. We have Dividend Day that was born out of Intel's earnings, so it's going to be a good show, I think.
Yeah, I think we need to find another stock now to have Dividend Day because it's not a dividend growth story anymore, right?
So, yeah, we'll find it. There's plenty of good ones out there. We'll definitely find another one. But before that, Berkshire Hathaway released the annual letter. Was it today or yesterday? Have you got a chance to flick through it?
No, I was just I was just drugged, literally lying in bed. So, but it's on my reading list for this week. But tell me, I'm really curious because it's one of these things I'm always looking forward to because they write it in such a timeless form that it feels like you're reading a novel.
Of course they did. It's like 12 pages. It's. I kind of shifted through a small bit. I only had a half an hour to spare this morning. I was reading through it, but you find yourself just getting lost. Warren just has such a way, doesn't he, of speaking to the ordinary person. It's he's like a big, huge mega investor, but there's no buzzwords. He's just talking to you in plain language, and he really draws you in. And I love the first page. You just look at it, just quite simple. Their performance against the S&P 500, which I know a lot of people like to base it off. And I mean, their performance has been incredible. But there was two bits that caught my eye as I was shifting through it. The first one was nothing beats having a great partner, and I was giving that shout out to you. Charlie and Warren are like that, so that kind of caught my eye. And the second one, he has the secret sauce, and it could not be any easier. But he goes on to talk about in August 1994, they completed a 7-year purchase of 4 million shares of Coca-Cola. That cost 1.3 billion, which was a meaningful sum to Berkshire. Now they're collecting 704 million in dividends every single year from that. I mean, he just keeps it so simple. He does go on to say that, like, although these are not spectacular gains, there is quite significant price appreciation attributed to that as well. But I mean, he gives it to you in plain English. That's really the secret here, isn't it?
So he's talking here about dividend growth investing as the secret sauce.
Pretty much. We need to get him on this show. We need to get Warren on this show. Yeah. But it's definitely worth the read. I'm going to print it out. I'm going to give it to my son, and I'm going to give it a proper read as well, because there's sure to be another couple of nuggets in there along the way.
Yeah, and what you mentioned about partner, of course, that's likewise, but always makes me wonder then, are you Charlie or are you Buffett?
I would be either.
Oh, you're a bit younger than me, so I think you should be Buffett and I will be Charlie. Let's take it from the age angle.
Okay, let's go with that. Not from the investment angle. That's purely based on age.
I will be the snarky old guy that shits on crypto, and you're the nice guy that's always friendly.
And speaking about European companies, actually, Bill Gates buys a stake in Heineken. I don't know if we spoke about this last week. I know it came up in some of our chats.
Yeah.
Um,
So yeah, Bill Gates is one of the best friends of Buffett, right?
yeah,
But also, what was it? This Epstein, as they say, if
yeah,
you want to talk about some complot theories. But he bought almost $1 billion in Heineken, in a Dutch beer company. Well, at the same time this week, Heineken was really under scrutiny of not leaving Russia enough, even continuing their business there. So it made them release a statement yesterday at the Heineken website, investor relations, to say like, hey, we're really trying our best to exit, but we can't so quickly because, then it wouldn't be good for our employees. We might get nationalized. And, when I'm reading that, I'm just reading like cowardness.
yeah,
These are just cowards. I mean, nothing stops them from pulling the plug. I understand you care about your employees, but you can also just give your employees a one-time bonus that keeps them under the water for a year. Or how do you say that? To find a new job, and that's it. I mean, I find this such a bullshit. Such a bullshit. They're just concerned about their profits. I think.
yeah. Of
I
course,
don't buy
of
it at
course,
all. I don't buy it at all.
of course they are. But I mean, it is interesting. Bill Gates is buying a stake in them. He doesn't really make too many mistakes when it comes to this. He probably has a lot of inside
Mhm.
knowledge. I know we did a show on our top 3 breweries there.
Yeah.
Must have been 10 episodes or so ago. And we both like Heineken, but their dividend history is just far too erratic.
Yeah, exactly. So maybe Bill Gates has been listening to the show. Who knows? He seems to read a lot and listen a lot. So yeah. I mean, it's interesting, yeah, because why I brought this up as a news item for the week. Many people follow these investors in their behavior, right, and try to be inspired by that. I personally, I wouldn't invest in Heineken because it's not a dividend growth story, but it is interesting that such a big public figure, who is also now really like a billionaire investor, is looking at a European company and then Heineken in particular. For me, this is really, really interesting. He could have chosen 100 other stocks, but he ended up on Heineken.
Yeah, yeah. I'd love to know the reasoning. There's obviously something behind it, but it's an interesting one to sit back and watch.
Good.
Dividend
But
hikes,
yeah,
dividend
we had
hikes.
so many dividend hikes this week. Unbelievable. And I think we have like 20 or something like that on here, yeah, on our list. So I will not go through every one of these, but maybe some call outs. Chubb, yeah, also, I mean, American company by roots, but a Swiss company nowadays. They hiked their dividend to 86 cents per share. It's they were at 83 cents per share. They're really doing small hikes in the last few years, and they do that more often. So what I've seen in their history is like they do like 5-6 years of small hikes, and suddenly boom, a 20-25% hike. So they're now in the phase of doing small hikes, but already 30 consecutive dividend hikes. Yeah, so it's really going nicely. It's an
Yeah,
insurance company that I own, so I'm really happy with this one again. But also Domino's Pizzas hikes the dividend by 10% again. For me, this is a growth story that people should actually look into. What they have been doing with their business is unbelievable. Thermo Fisher, a medtech company, hikes the dividend by 17%, so ticker symbol TMO. Then the Deere and Company, these guys selling tractors. I really dislike them because I had them on my radar once and I didn't pull the trigger at the time. But there's been such a growth story since then. They did a 4% dividend hike and pay a new quarterly dividend of $1.25 per share, ticker symbol DE. Now, Walmart also hiked their dividends, so ticker symbol WMT. It's their 50th, I believe, so they might be dividend king now. They hiked it by 1.8%, and it's already for the last few years small hikes, right? It's really a dividend darling in the US. They pay a low dividend. I think they are heavily overvalued. And I don't know what's really happening there. The last time I looked in it, they bought this digital online e-commerce business that was several years ago. They had to heavily invest in that, I remember. But then I look at Ahold at the same time, which is also having large US penetration in the market. And then I think like something is fundamentally not going well with Walmart, I believe, at the moment, because this is so out of the pattern. And if you then compare it to the next American one, Home Depot, they hiked their dividend by 10%, ticker symbol HD. And maybe there's also a call out. Check the latest video of Ian Lophook. It's about Home Depot. And he is so funny when he starts his latest video. He has like a bucket and then he goes through, he picks out all kinds of stuff. You need to really look it up. It's so funny. And maybe spoiler alert, but we have Ian Lophook next week on the podcast again. So he will be revisiting us.
Can't wait. I can't wait for that.
Yeah, so if people have any questions, guys, ping us on Facebook group or on Twitter and let us know what questions you might want to ask him. We're really looking forward for that one. But then these were some American hikes, but listen up to the one that stood really most out for me this week was Wolters Kluwer. They hiked their dividend by 15% to 1.81 per share. Unbelievable, right? Unbelievable.
For such a boring company, that's quite a hike.
Yes. And then one of my favorites in my portfolio, I bought them at €160. I think they're now trading about €300. I think they're slightly overvalued, but still, Munich are reinsurance, so ticker symbol MUV2. They hiked the dividend by 5.5% to €11.6 per share. They have a dividend policy of growing the dividend by 5%. I think they have been maintaining or growing the dividend since the late 70s. So again, amazing, I would say. Also, really a small cap that I own, Defama. They hiked their dividend from 51 cents to 54 cents per share. We had the CEO, was it Matthias, on the show here. Danone is back with a dividend hike. Hey, from 194 to €2. I mean, and that's interesting. And maybe we should talk a little bit more about this because I still own Danone. And I start to like what I'm seeing. I think the new CEO is finally getting into it. So what they did is they decentralized their business again. They gave the regions their own profit and loss. They have been doing a good business again on the vegan stuff that they are selling. So they start to turn around a little. I start to see the first signs of growth coming back to this company.
Yeah,
and I'm happy that they restored the dividend a bit again. So it's, I mean, how you said, one swallow doesn't make a summer, something like that.
But I have to say I follow these guys closely. I have them in my portfolio as well, but I also write for them for sure dividends. So I have to every quarter check these guys out. And I'm liking the new CEO. Everything, you're right, everything is returning to growth. Europe is a little bit slower, but it's starting to come back. And with China opening back up, I think we're going to see a different beast over the next 2 or 3 years. I think finally we have somebody in charge that knows what they're doing, and it's
not overly woke as well, which I think also helps. Okay, and then BASF remained their dividend at €3.40. I think it's no surprise that they would remain it under these circumstances. Ageas, I believe a Belgium insurer, increased the dividend by 9% from €2.75 to €3. And these were also called out on our Facebook group. So the AXA dividend, the French insurer, a 10% hike compared to last year. And then this one, I don't know the company, but I just wanted to call it out because it was posted in the Facebook group. Brødrene A und O Johansen AS. They just proposed to raise their annual dividend by 16% to 5.25 Danish crowns. And then also a little bit of, is it bad news? I don't know. I own few shares after I sold my Castellum. I bought some Cibus, Nordic Real Estate, and they cut their dividend from 99 cents per share to 90 cents annually per share. When this is a monthly dividend payer, so a 10% decline. It's a really high yield play. The reasoning for them to cut a little bit is because the increase of interest rates hikes. They are not like Castellum just doing the whole dividend away, but they're just saying like we want to be conservative. but they hope that they from here can continue to grow again, because they were so far a nice growth story. They're trying anyway to clean up the balance sheet to at a certain moment get a credit rating. So there's the balance sheet in general, there's really a risk, but their portfolio is really nice. So also full disclosure, I own some. I'm not intending to sell. I found the dividend not that safe as maybe with some other stocks. So it's a high yield play for me, even more than a dividend growth play.
Okay. And I think that brings us nicely then into our main topic, which is about Intel cutting their dividend by a whopping 65%. I mean, I don't think the market was surprised or investors were surprised. I think a dividend cut was coming. But what were your thoughts? What were your thoughts when it came?
I was not surprised at all. I did a video like 2 or 3 weeks ago when I annualized their earnings, and when it mentioned we're committed to a competitive dividend compared to I said the growing dividend. This was all out of the playbook of AT&T. So I was not surprised at all. I expected a half a dividend cut. Yeah, so instead of 62, so it was a little bit more than expected, but it was up in the air. Of course, I was hoping for a flat dividend or a growing dividend, right, as an investor. But it's of course a disappointment. It's always disappointing when your income, gets a bump. But it is what it is. I think we obviously now need to talk a little bit on the show here also at the business, because I think it's always first the business, then the dividend, right? Because if we are talking about dividend growth investing, particularly, we should have emphasis on growth, more on dividend. Yeah. And of course, we have been discussing so often over the shows here that this is not a growth story, but that it's a turnaround stock.
Yeah. My initial reaction, pretty similar. I was not expecting 65. I was expecting a more gradual, maybe 40%, 50% cut. Looking at their balance sheet, I can see why they've done it. My worry is I feel like they're going to have to cut again, and they might have just been better of just getting rid of that dividend altogether. That's my worry. They've given some pretty weak guidance going into, I think, this quarter. They've openly said it's going to be the worst quarter they've ever had. That's probably going to trickle into the next year. So I can see that dividend being cut again, if I'm being honest. And full disclosure, I've sold out of my position because I was happy to hold them as a turnaround play while I was getting paid to wait. I don't feel like I'm getting paid to wait now, so I need to see that turnaround story turning around before I get back into them.
Yeah, and how do you feel then about this? Do you feel like this is the same story as AT&T at the time?
Not really. So AT&T is a little bit different. It's mismanaged, and their capital allocation is completely different. I believe in Intel more than I would do in AT&T, right? However, AT&T, when they cut the dividend, I was still getting a decent yield on cost, and I'm still technically getting paid to wait. Here, it was a huge cut. I sold out of them at a really good price. I bought back in about 30 or 40 shares at around $23, $24 I think, which was fine. I sold them again at 25 here, so I didn't really lose any money. But my thoughts is that I still see a lot of pain here. I still see another year of bad news coming out and the market reacting, a lot of volatility. And given their guidance, given that they're struggling with their legacy products, their capex is going up, their free cash flow is hampered, I think another dividend is going, a cut will come again. And then maybe that might be a time I might start to look in, because let's be honest, this all came about from 2020 when they were late on that, was a 7 nanometer chip. I think it's not Pat's fault. He inherited this, but I think that's the time when they started to drop, isn't it? I know they had a bumper year that year, lockdowns, PCs, sales went up, but I think that was a defining year for them. And they've been losing market share since. So I think there's a lot of work still has to happen. I still think it's maybe 24 months away from starting to flatline and seeing a better opportunity. But I mean, as a value investor, they may start popping up on people's radars now, because the price does look relatively I won't say cheap, but it's starting to look a bit more favorable in terms of where the balance sheet is. But as a dividend growth investor, where my goals this year were to invest in quality, as soon as that dividend cut came in, I didn't want to hold them in the hope that it'll return at one level. I want to see them turn that corner before I get back into them.
Yeah. Well, we always say, for hope you go to church, right?
Yeah, exactly. Yeah.
Yeah. So also my full disclosure, then I kept them here, but for me it's really easy to keep them. Listen up, I've always seen it as a turnaround story more than a dividend growth story, and I hope our listeners did it at the same from this point of view, so that people are not really suffering from this. Because for me, it was like a 1 or 1.5% of my entire portfolio. So for me, it's really not hurting me, this dividend cut. I've seen this as a turnaround story. What does a turnaround story mean for me? I allocate 10% of my entire portfolio into stocks where I want to nurture my feeling a little bit of for value investing. And I must confess, I've been more wrong than right there in this one. Because one of the learnings I have, it's value investing is nice, but you need to know when to sell. Yeah, so I've got Alibaba in there. I've got Meta in there. I bought Meta at the time 170. They went to 300 something. I didn't sell. Why not? Yeah, so these are the learnings I'm taking now there. And that's going for me through a similar pattern as dividend investing. Yeah, I'm doing this now for 2-3 years, this 10%, because I noticed that I was making some mistakes in my dividend growth, and I started to recognize, but actually I'm not dividend growth investing here. I'm just doing value investing, and I like that as well. But now I learned I don't know when to sell because my whole mind is wired towards dividend growth investing. So this 10%, that's where it is in, and here I need to get better at. But for me, I said, all comes down to the growth expectations that you have for Intel. Can they get back on track? So for me, what is most important is this year 2025. If they nail it, I can see this stock easily at $70-$80 based on free cash flow expectations. So this is what I'm aiming for. You and I both said enough that it takes 2 years. It got a little bit more worse. It's not so much a surprise to me, although I did adjust my models, my own expectations here as well, because of course CEOs are always a little bit more optimistic in their guidance as well. That's what we learn here as well. It's not everyone is an Ahold CEO. So from that point of view, I'm keeping it. I would sell it in this case if they are not living up to their expectations with 2025 to be back on track with some really important topics. I might even consider rounding up my amount of shares to a nice round number here in the next few months, for instance, when it gets to $20 or something like that. And for the rest, it's just collecting dust on the shelf. And I hope that my capital will give me a nice appreciation over the next 3-4 years. That is more than I would have got when I would have put it in the S&P 500, because it's part of this 10%. But if this would be for me a dividend growth story, I would have sold it, because there my rule is almost directly sell it unless. And with Shell, that was an exception because we knew where it was. But with Intel, I don't have that same prospect on dividend growth here.
Yeah, I mean, look, they have cut their dividend in line with industry standard. I think they yield around the same price now as some of their competitors. I can't remember who, but I don't see that dividend growing anytime soon. So it is a pure value play, and that's what I'm thinking. I see that balance sheet weakening this year. I really do. And I think the share price will reflect that. If it starts sitting under $20, I'll start getting interest again. But I go back to 2020, because it was really a management issue, and that product was a Sapphire Rapid, that new chip that they have. It's apparently, I don't know, but apparently it's a pretty incredible product, better than the AMD's Milan series. So if it was released on time, and it's fine margins, but if they had released that on time, we'd be sitting here having a different conversation. That dividend would be safe. The business would be generating a lot more cash flow. It was purely management made wrong decisions. They were late pretty much for a decade on all their chips, and they've been losing market share. So Pat has got his work really cut out for him.
Yeah.
but from a value point of view, I can definitely see the interest in this.
Yeah, and maybe it's confirmation bias, but I read when I was not sick yet, I read an article about how their new chip is performing compared to the Apple M3 chip, I believe.
Yeah.
And it got really good reviews. The only thing it said, like that was funny, like for gaming and high performance, it's really, really much better, but you need to do it on the power of the notebook. So is it really then a notebook? Yeah.
Yeah.
But generally speaking, they were quite impressed with the performance of it. And for me, these are the kinds of articles that I read for this, because this shows us whether I said HP and such vendors will be interested to offer this to their clients. Yeah. And I think that's important for us.
They just need to start delivering on time, and that will start gaining back a little bit market share. I mean,
yeah, exactly.
2 years is too long in this market. It is far too long to let your competitors grab that market share.
And now actually all these chip producers are getting hammered at the moment, except maybe for Nvidia, at least from share price point of view, because there's just really weak consumer demand. Yeah, people had extra cash during COVID, all bought laptops. Now there is like inflation and everything.
Yeah.
Come on, the last thing I think about is buying a laptop right now.
Of course.
Yeah, I mean, I think most people think about paying down their mortgage at the moment, because that's the biggest expense in their family budget.
Yeah, I mean, I don't question that the market as a whole, or even Intel, will turn around. I don't really doubt that. The question is when. that's the question.
Right.
And then trying to time that is probably something I'm guilty of, I will say, by selling and thinking they'll drop lower. But I was more than happy to wait when I was getting paid to wait. I don't really don't really want to do it at the moment until I start to see either balance sheet getting stronger and growth prospects delivering on what they're saying. So that's where I'm at.
Yeah, and here I would just advise our listeners, right? What helps me in these situations to not sell or to sell is that I did my homework up front. So for every stock, I list my one-liner thesis. Why do I own it? And it clearly reads around Intel. It's a turnaround play. Watch out for 2025. Yeah, that's what's written there. And I think everyone should do this, because when there is a dividend cut, you're in an emotional state. So if you do your homework up front, you know what you're looking for. And if that one master thesis that you have for the stock is not upheld, I think it's a pretty good reason to sell. Yeah. So I think that's really important for listeners to do, because if you now need to start wondering, will you sell or not? It's really hard to make a rational decision. You will be influenced by everyone on social media. You will be influenced by articles written. You will be influenced even by I know what strangers say on the street about Intel. Yeah. So
yeah. I mean, you just have to look at us, for example. We took two completely separate views on this. So who do you listen to? Who's right? So I agree with you. You need to do your own homework, your own research. My thesis was, I don't mind waiting once I'm getting paid to wait. Once they broke that by I probably would have stomached maybe a 10-20% drop. But once they broke below 50, I was all out.
Yeah. And rightly so, I would say.
We'll see. Nice one. So I'm definitely interested to hear from the community what you're doing around Intel. What did you do around the cut? Are you holding? Are you selling? Are you buying more? So please drop us comments on Facebook, Twitter, emails, wherever, and let me know what you're doing. I've already made my decision, so you can't influence me anymore.
Cool. So I hope to our listeners that we clarified this. This was like a question we got a lot for this show. I hope we can really talk more about dividend growth stocks again going forward. I think there is something in that, right? With AT&T, it created a lot of fuss because these are iconic companies that people hold in, and effectively they become value traps at a certain moment. And then the yield goes up. It becomes really really interesting for yield hungry people, which we are also victim of from time to time. So
what I have to say is we do openly talk about our mistakes that we make on the show, on our blogs, but Intel was one of the learnings, and I probably took that from AT&T. I did see quite early on their dividend was at risk. I mean, the cash flow doesn't lie. You could see that. I'd sold out at them at around $56, if I remember correctly, at around the time, and I only bought back in when they took massive hit, but under no illusions that dividend was pretty much not safe, and with the thesis that I would sell if they cut it below a certain point. So I knew what I was getting into, but with AT&T, I could see it, but I didn't want to believe it, and I didn't act. And now I just left it too long. So yeah. I'll take that as a learning. If you just keep learning a little bit as you go along, then maybe we won't have any more dividend cuts.
Exactly.
Portfolio review. We have one from Sebastian, a 30-year-old guy from the UK. So he got really serious about investing since COVID. Regularly invest every month, around 500 to 1,000 a month, pretty similar to, I think, most of us at this stage. He is inspired, obviously, by Jason Fieber, like a lot of us, and he's given us some of his portfolio. It yields around 4.7%. It's broken up into nearly equal split between US dollars, euro, and Great British pounds in income, which is nice. And just to give you a rundown of his top, I'll say top 5 companies. So you have ING Group. I'm guessing that's group in Dutch. Ticker symbol INGA. You've got Shell PLC, Unilever PLC, Realty Income, Total Energies, and Siemens AG. A lot of European companies there. What are your thoughts?
Yeah, of course, ING Group, number one, is a red flag to me. It's a bank, a Dutch bank, one of those banks that is not trustworthy. We saw that in 2008, 2009. They got a lot of fines over the last decade. So for me, for that point of view, it's an uninvestable company. But had to give it to him. A dividend yield of 7.5% is a lot, but it's also taking most of his annual income. I don't see ING Group as a reliable dividend payer here, so I would really watch out with that one. And if I were in Sebastian's case, I would even say, like, I don't know what your plans are with the stock. If you want to hold it forever, then of course your annual income percentage will get lower over time because you'll be adding to others. But to have an ING Group as number one is for me a big red flag. Other than that, I like a lot some of the holdings here, like Shell, Unilever, Realty Income, Siemens, but also stock like Iberdrola. I think it's really a nice one. But generally, I would say I'm missing at times a little bit of the more high quality names that we know from the US, which I would recommend. Is a lot of, let's say differently, there's a lot of old industry in here. That's how it feels.
Yeah. Well, what I'm actually missing is, I know you're from the UK, and the UK has quite a strong stock market with lots of great companies. And typically, whenever you see a UK investor, you see a lot of strong UK dividend growers in there. And I don't get a sense. You have Unilever, but they're Dutch, really Dutch UK. But I don't see too many. You have Vodafone, maybe there's one. I don't think they have a great track record in terms of dividend.
No, they
either.
also cut their dividend a few years ago.
But I'm just lacking some UK, particularly as you are a UK investor. I'm not sure if the tax is different. Maybe it is, but there are some strong companies I would consider from the UK. A lot of what I can see here, a lot of financials. He's got the Bank of New York, JP Morgan, China Growth. That might be a ETF, maybe. But I'm missing the same as you. There's not a lot of growth. You have Texas Instruments there, but it's a really small position. I would probably inverse the percentages of what you have in some of the companies. There's a lot of high yielders there with a lot of risk. I would say it's a high yielding portfolio. It's quite risky, and I would probably look to steady the ship a little bit with some UK stocks and some dividend aristocrats in there as well.
But what I think is good to say, because he explains it well, right? He started really doing this during COVID. Yeah. And remember at
Yeah,
COVID
of course.
times, everything was heavily overvalued. So it's no wonder we were fishing in the same pond at that time, right? Fishing for similar stocks because
Yeah.
it was just really hard. But if you look at it today, come on, you get Johnson Johnson for 2.95% yield. I know they have, of course, litigation piece on top of it, but still, it's like the dividend king of dividend kings. Yeah, there are even more of Texas Instruments at the current price here. Of course, it will lower a little bit the portfolio yield, but it brings this dividend safety into the portfolio. So, and this is what I would Sebastian, this is what I would really advise you is like analyze the dividend safety of your portfolio. I know you have the credit rating there here as one of your measures, but also look at the dividend safety. So that could be a combination of payout ratio, earnings power, and such, and study it a little bit to understand, like, can these companies, all these companies now, in 10 years from now, still pay you a growing dividend of, I don't know, 5, 6, 7% per year? I think that's the question you need to ask yourself.
What have they done during the last recession? I think that's a key component as well. Do they have any resiliency in a recessionary period? I know we haven't got there yet, but there is lots of talks that we could enter it. I know the UK was on the brink of a recession there at the turn of last year. So just, I would agree, check the risk profile, how they perform during recessions, and do you believe that they will still pay dividends in the next 5, or even grow dividends if growth is your metric in the next 5 years. But look, overall, I do like some of your companies. I'd love your position in Siemens. I'm jealous you have a lot more of it than I do by the looks of it. I do like that. You have also got Munich RE, must not forget. It looks like you got them at a decent yield as well. So you've got some nice companies in there. For me, this feels a little too risky for my liking.
Yeah, same here. Thanks for submitting, Sebastian. I hope that our feedback is helpful. Remember, you can borrow conviction from us. It's your portfolio. You might be much better off than us. You just heard us talking about our Intel dividend cut, and I see you don't have Intel in your portfolio. So take it with a grain of salt. But yeah, that's just our opinion. Good. We also got a bunch of listeners' questions, right? And the first one is from Alexandras here. And he is asking us, how do we handle companies like Rio Tinto, ticker symbol RIO, in our PADI calculation? So PADI stands for projected annual dividend income. So they had a base pay dividend and an extra dividend for the last few years. And he's wondering, should we include the extra dividends in our PADI, our projected annual dividend income, or not? Because otherwise it feels like we're now getting a dividend reduction. So what is your approach to this?
I do not include it in my projected annual dividend income, because obviously you're projecting what your dividend income will be. And I like to know what that is. Special dividends are not certain. There are some companies like Rio Tinto, like EOG Resources, like CME Group, who do pay them regularly, but they're not guaranteed. I know dividends are not guaranteed either, but at least they pay them every quarter and they have a base amount. So I do report them when I'm doing my portfolio reviews, but in terms of my calculations and my PADI calculations, I ignore them completely.
Yeah, I have the same. Special dividends, I take them, with a big smile when they come in.
Yeah, it's like a bonus.
But not for my projected annual dividend income.
It'd be similar to if you're if working for a company, you don't get a bonus every year, but you get a bonus maybe on year 4. You would never sit down and calculate your bills based off receiving that bonus and your salary.
Generally, even if you get a bonus every year, I don't calculate it even in there, because I think a bonus, the name already suggested, right? It might be that you're not getting it if your company is performing poor that year. Look at Intel; they're even considering cutting people's base pay at the moment. So I think you should always leave that out of your calculations and just be happy when you get it, and do an additional splurge or something like that.
Dave has asked us 5 questions. They're quick, so I will ask all of them. What is your best Spanish dividend stock?
The one I still like the most is probably really, really controversial, but it's Enagas.
It's the only one I hold, so it is my best Spanish dividend stock. Do you think that the Yellow Submarine song is about Villa Real? Yes. Would you consider to invest in Man United stock? Hell no.
At the moment, oh yes.
No way.
I'm following Manchester United already since the beginning of the season with Erik ten Hag as a coach. I really enjoyed them watching them on Thursday when they beat Barcelona. Today it's Sunday while we are recording this, and they will play the League Cup final against Newcastle at I think 4:30 English time.
Yeah.
So I don't know if they will win. Newcastle only had 5 goals this year against them. 5 goals this season, the lowest number.
Yeah.
So it will be really tough. But Man United, they're talking about the turnaround play.
Well, I'm supporting Newcastle, and that's that. The next one is: do you think that the Bulls took over the market? Honestly, I don't know, and I don't care about that stuff. I don't know, get that, but it's hard to know. It's hard to know. And the last one is: how are you? And I am good, Dave, and I hope you're well too.
Yeah, and Dave, ask me again in a few days when I feel better. I believe that I've been in touch with Dave a few times. I believe he's also from Poland, and we should do one time something in Warsaw and go for a beer with a few of our podcast listeners. So if you're interested in that, send me a message on Twitter or Facebook. Maybe we can organize something with you guys.
Nice. I was going to skip past all of the Intel questions, but I just seen one here, and I'm going to ask you because it looks an interesting question. Dennis says, what to do with Intel? We've discussed what we did, right? But the disclaimer is the bit that I want to ask you. He has sold his position because the CEO isn't trustworthy. What are your thoughts on that?
Well, it's hard to look into someone's brains. Yeah. Here, I don't know what he bases that on, the not trustworthy.
I think he bases on that video that was you referred to when they were talking about a competitive and healthy dividend, and then they've cut the dividend.
Okay, yeah. Yeah, what can I say about this? I don't have that feeling. I understand the language nowadays of competitive. Yeah, what this means. Maybe it's an accounting term. Maybe it's a legal term they have to use. I didn't have a feeling that they were misleading us around the dividend. So that's why I don't feel like that. Where I'm having my doubts with Pat Gelsinger is, while he might be a great engineer, is he also a great manager? And that's not what I'm getting yet a good feeling about. So I do get a good feeling when he talks about the technology, but when you see his management style, I don't know. Because, for instance, now asking employees to take a pay cut, if you're in the middle of a turnaround and you need to count on those same employees, they will not forget. Around that. So I rather doubt a little bit about his management style. Not so much about him not being trustworthy. I mean, you should follow him on Twitter. He's praying every Sunday on Twitter. I mean, he should stop doing this stuff, by the way. But no, I don't have this issue with trustworthiness, but I think this is personal, how you read his messages and such.
I mean, they're in a competitive niche, aren't they? And if you're asking your employees to take a pay cut, only those that are really, really loyal Intel will stick around. If you could work with NVIDIA, AMD, Taiwan Semiconductors, you would be gone in an instant. And then on top of that, trying to attract top talent. It's not going to happen. So I always find that should be the last resort. But in terms of trustworthiness, I don't think so. I think he was quite upfront. He was asked directly about a growing dividend. He never said it was going to grow. He said he'd keep it healthy and competitive. He's technically done that, because where were they financing this dividend from? They weren't producing the cash flow for it, so they have to finance that from somewhere. So I think he was the terminology. I can understand when you're listening to him, you want a straight answer, but you got to remember these guys are sitting in board meetings. They're talking to people. They can't just come out right and say, "I'm cutting this dividend in 4 weeks' time." They have to use the slang. But I think there was enough hints there I believe he is trustworthy. Like you, I think his management skills will be tested in the next 2 years. But certainly from a trustworthiness point of view, I don't buy this argument. No.
I hope that Pat Gelsinger, right, from a technology point of view, brings this in a good space back, and then becomes, let's say, head of technology or something like that in Intel, and that we get another CEO that is maybe better on the management side.
Cool. Tim has asked us, do you know what happens to drip shares when there's not enough to buy a full share? Did they just hang there with your broker?
I actually... Okay, so I can tell you what happened to me when you're dripping, right? So automatically reinvesting. If I don't have enough money for a full share, I get the money paid out. So then I don't get a share added. So I guess it depends on what broker you have, because if you're in like trading 212 and you automatically reinvest, it just buys fractional shares. But I assume that Tim is asking here from a point of view where you are with a broker that doesn't allow you to do fractional shares. So in that case, you just get the money deposited on your account.
Yeah, and I know you can do it directly with the company as well, can't you? You can drip, and I would assume that if you do it that way, they would just give you fractional shares. But again, it's broker dependent, and I would check with your broker before. It's probably different for each company and each broker as well. Jay looks like an Irish name, and I still can't pronounce it, but he said he's new to investing, and he has a question on how much you decide to hold of each stock. Do you work on a dollar amount or a number of shares per company, or what's your method of deciding?
Yeah, I actually wrote a whole article about that. It's my dividend portfolio allocation strategy, Jay. Check out my blog, europeandgi.com. You will find there a link to that one in the menu item. For me, it's more like I've got my tiers. So tier 1, tier 2, tier 3, tier 4. They have a certain percentage allocation. And that means like I don't want a certain stock to be more than that, and tier 1 is my top, and I believe it's 4% maximum per position there.
Yeah, I have a similar kind of a process as well. We should link to your article actually in this to make it easier to find for Jay. Anders has asked, if you're not concerned about total return, would single stocks be better than ETFs if you only focus on the dividend?
In my opinion, yes, because I believe that the European ETFs that we have at our disposal are not really growing the dividends, or if they are, they have such a low yield that is not worth considering.
Dermot McNamara has no exposure to the energy sector. He feels he's missed the boat as valuations are very high, which is true. If you had no energy exposure in your portfolios, are there any stocks you would add to right now? Yes, there is one that I would look at, and it is EOG Resources, ticker symbol EOG. I write about these guys for sure dividend, so I won't say a whole lot, but I think they are a extremely well-managed company. I spoke about them earlier. They have a solid dividend history, and they like to pay special dividends. I think they paid something like $5.20 in special dividends last year alone. And the valuation might not be as high as some of the others in the market. So that would be one I would check out.
Yeah. Go ahead. Javier is asking if we have any thoughts on Verizon, ticker symbol VZ.
No, do you know what? I still think I own them. I think I have about 4 or 5 shares that I bought way back, and I've never actually looked at them again. I thought I was going to sell them. I have a sell order in, and it never hit the price. But they're in the same boat as Intel. Really, not Intel, AT&T. High debt, declining business, but I think 5G is where their play is at, and I think they are better managed than AT&T from what I remember. But as I said, it's been about 3 years since I looked at these guys, so I don't know.
Yeah, so for me, I'm not so interested in these kinds of telecom providers, specifically in the US. Also, after seeing AT&T and Verizon, I've got similar thinking, although they are better managed. If I would invest in any telecom, I would go more for T-Mobile US. I find them way more attractive as a business, how they're operating. And with 5G, I think it will not be the telecom providers that will be benefiting the most from 5G. They are doing the heavy to capital investments. So I would rather then go to Qualcomm, where they need to buy a lot of stuff from. Also the the smartphone producers as well. Or I would go to those companies where their services will benefit from 5G. I don't know if that's Google with YouTube or something like that, but I would go more for those service providers.
Yeah.
I think the telecom providers are just paying the bills for all other companies to benefit from 5G.
Yeah. I mean, if you want to look at a telecommunication stock, I would look at a company called Cognet Communication Holdings, ticker symbol CCOI. I mentioned them before. They have a very niche, they target businesses with fiber optic, and it's very niche. They're well managed. They have a stronger balance sheet than AT&T and Verizon, and they increased the dividend, I think, every quarter for the last 42 quarters. And it's well covered. It doesn't look like it's in any trouble. So I would check those guys out if you're looking at a telecommunication. They're yielding around 6% as well, which is quite decent. One thing I will say, if you do look at them, ignore the PE ratios, and maybe look at EBIT or EBITDA. The PE ratios get skewed quite a bit, but it's a decent company. Vin has asked us a question about tax optimization. He lives in Belgium, which carries quite heavy dividend tax of around 30%. He's asking around accumulating ETFs where the dividends are reinvested automatically and basically avoiding this kind of tax. What's our thoughts on that?
Yeah, I think when you're suffering from that, right, from such a high tax, then you need to really look at tax optimization. But I would still like to highlight one thing. In the end, in general, right, if you are not, for instance, paying capital gain tax as well, you could also think like this. You just put everything, I don't know, in ETFs for total return or in stocks for total return, because this would be, for instance, in the Netherlands, I think under the old system, I don't know if the new system is the same, you would just accumulate to a certain amount and then you switch your portfolio, I don't know, to a dividend income portfolio and start living in Portugal where it's maybe not taxed for the first 10 years or something like that. That would be geo arbitrage. So I think you can still define a strategy like this. But also another thing, 30% dividend income tax might be still better than tax from income. Yes, so if you are paying tax from income 40 to 50%, then dividend is still taxed less. And I would also keep this in mind. So yes, it's definitely not nice, specifically if you know that the countries around you, like the Netherlands, are charging you a 15% dividend tax. Yeah, then so obviously not nice.
Yeah.
But generally speaking, you need to really look at your situation. I don't know the tax situation in Belgium, but there are so many ways you can make money in the stock market to come to this financial freedom situation. But I think we're not the right persons to ask for that, what to do as a Belgian citizen.
Yeah, I'd have no clue. I wouldn't even attempt to answer that. 30% is not nice. This is one thing Europe has to sort out. Get everybody on a level playing field, and I think that's one thing I would love to see. But in terms of ETFs accumulating, I know in Ireland it's similar. A lot of people would do the same because the tax is too high on distributing ETFs. So talk to a tax advisor would be my suggestion. Last question is from, I think it's Mike. You can probably pronounce that better, but it's what is your opinion on the current low company's valuation? I'm not too sure. It's not a company that I follow. They're trading at a PE ratio of around 14, 15. So I don't know if that's competitive or not. Just looking at the financials quite quickly on my screener, they seem quite well. They would pass my screener to look at. And a 14 PE ratio seems reasonable enough in that sector. But honestly, I don't follow the company closely enough to give an opinion.
Yeah, so for me, Lowe's is like the biggest competitor of Home Depot, right? And So they're in the do-it-yourself home improvement here. And generally, I like this company a lot. Also, good dividend track record. But at the moment, I'm still not really interested in it. But maybe I should just start to analyze it a little bit again. I believe I added it somewhere not too long ago in one of the videos that I made. But generally, I think it's a high-quality company that should be at least on everyone's long-term watch list.
If you were to compare them to Home Depot, they appear to be better valued. Just looking at P ratio and that they seem to be a little bit more attractively valued. But again, you'd have to compare the two and look into it a little bit more. But nice. Okay, that's the end of the show. Thank you for sticking with me, EDGI. I know you're not feeling the best, so we'll get this over and done with. But thanks a million to you, to all our listeners for tuning in. And next week we'll have Ian Lopok on the show, and I cannot wait for that. So stay tuned, and we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.